Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. It is the beginning of a new month. I hope you have a productive November ahead. We begin today's episode with yet another month of disappointing economic numbers, surprising even usually upbeat economists. Let us briefly move through the main data points. According to official National Bureau of Statistics numbers published yesterday, Tuesday, China's factory activity fell back into contraction in October, while an expansion of the services sector unexpectedly eased, quote, signaling that the economy remains fragile and is in need of support, end quote, in the words of a Bloomberg economist. The official Manufacturing Purchasing Managers Index slipped to 49.5 last month from 50.2 in September, well below the estimate of 50.2 in a Bloomberg survey of economists. Manufacturing activity recorded its first expansion in September after 5 months of contraction, according to the official index. The PMI numbers partly reflect seasonal factors due to an 8-day holiday in the beginning of October, but it also shows market demand remains weak. The non-manufacturing gauge, i.e. construction and services sectors, declined to 50.6 from 51.7, lower than the forecast of 52. US-based The Wall Street Journal writes that the weak results, quote, contrasted with economists' more upbeat forecasts after an improvement in growth in the third quarter, end quote. Robert Cornell, head of research for Asia-Pacific at ING, told the outlet, quote, the readings were a slight shock that suggests that the economy is still struggling, end quote. Julian Evards-Pritchard, head of China economics at Capital Economics, in a note expressed similar feelings, writing, quote, up until this latest data release, things were looking better, end quote. The usually quite upbeat China economist went on to admit that the numbers were, quote, the worst on record if you ignore COVID lockdowns. This suggests that the services sector was barely growing at all, end quote. And remember, these are official numbers, but we have non-official numbers too. The Caixin China General Manufacturing Purchasing Managers Index, PMI, which seeks to give an independent snapshot of the sector, fell to 49.5 in October from 50.6 the previous month. Wang Zhe, a senior economist in charge of the index, expressed with the publication of the numbers, quote, the economy has shown signs of bottoming out, but the foundation of recovery is not solid. Demand is weak. Many internal and external uncertainties remain, and expectations are still relatively weak, end quote. Most commentators agree that a trigger-shy Beijing may need to pump more fiscal stimulus into an already debt-fueled economy. For example, Raymond Yang, chief economist for Greater China at ANZ Banking Group, expressed yesterday, quote, given the downside surprises, the authorities will still need to deliver growth-supportive policy, end quote. Zhang Zhiwei, chief economist at Pinpoint Asset Management Co., said the government should raise the fiscal deficit for 2024 to drive a more sustained economic recovery and provide more support for China's still very sick property sector. And speaking of property, things in this field are not looking too good in October either. According to preliminary data from China Real Estate Information Corp, published yesterday, Tuesday, the value of new home sales among the 100 biggest real estate companies fell 27.5% from a year earlier to 406.7 billion yuan, approximately $55 billion US dollars, narrowing from a 29.2% decline in September. Sales gained 0.6% month-on-month. Chen Weijing, Associate Research Director at China Index Holdings, expressed the same day, quote, the subdued home prices have kept home buyers at bay. The current supportive measures have had some effect in some of the bigger cities, but the policy effect doesn't look stable, end quote. Recently, S&P Global Ratings warned that if the property crisis deepens, then 2024 could see China's economic growth drop down to below 3%. Now, this is a lot of bad news, but there is one piece of good news for China too. According to a monthly tracker of the Chinese currency, released by the Society for Worldwide Interbank Financial Telecommunication, or SWIFT, the Chinese yuan became the second most used currency in the global trade financial market in September, surpassing the euro for the first time since the data became available 6 years ago. As we can see here from the Chinese financial media outlet Caixin Graphic, the yuan share of global trade finance climbed to 5.8% in value last month from 4.82% in August, whereas the share of the euro dropped to 5.43%. Caixin explains, quote, China has been ramping up efforts to expand the use of yuan in cross-border transactions as an alternative to the dominant US dollar. Top leaders have been encouraging countries to settle energy trade with China in the Chinese currency, and Beijing has been setting up yuan clearing banks in offshore markets to cater to cross-border yuan settlements. End quote. Of course, the shares of both are still well below that of the US dollar, whose share recorded 84.15% in September. Okay, this is part one. Before we move on to the next part, one small matter to discuss. As we expected, yesterday, Tuesday, the White House press secretary confirmed that US President Biden and China's General Secretary Xi Jinping will meet in San Francisco this month. We will be discussing US-China developments in tomorrow's video, so we'll just note this update here, but unpack it with other relevant developments tomorrow. Next up, China's financial system. If you're getting some value from today's episode, don't forget to hit the like button. Sharing with people who you think would enjoy this sort of content is also a huge help. And for those who want to go the extra mile and help me keep the channel financially sustainable, primarily supported by subscribers like you, so that I am able to produce these 6 days a week, free and open to all, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. Let's continue. The Central Financial Work Conference has concluded in Beijing. This is very important for us to follow. Regular viewers know that financial systemic risk, especially at the local fiscal level, is a seriously acute issue facing policymakers. This conference discussed this very issue, as well as other topics related to the wider financial system. Liu Shengjun, chief economist of the China Financial Reform Institute, a private think tank in Shanghai, speaking to Hong Kong-based South China Morning Post today, expressed on the meeting, quote, the top leadership's assessment suggested that the financial situation is severe. Compared to previous conferences that highlighted innovation, they now lay more emphasis on financial regulation and risk prevention. End quote. Commentators argue that the official readout indicates high-level directions, with the specifics to come in the coming weeks and months. Quote, the long readout was heavy on high-level goals and aspiration, but light on details. But the path is set. Now we wait for more specific policies. On the key topic of local government debt, the readout said the meeting advocated for establishing a long-term mechanism to prevent and resolve local government debt risks, setting up a government debt management mechanism compatible with high-quality development and optimizing the debt structure of central and local governments. End quote. More on this in a moment. The authoritative state-run Securities Times published its own list of 12 key points from the conference. Let's just look at a few. 1. Finance is the lifeblood of the national economy and an important part of the country's core competitiveness. 2. It is important to be aware that various contradictions and problems in the financial field are interwoven and influence each other, some of which are still prominent. 4. Great importance should be attached to developing technology finance, green finance, inclusive finance, pension finance, and digital finance. 8. We must timely deal with the risks of small and medium-sized financial institutions. 10. It is necessary to improve the system and mechanism of the party's leadership over financial work. 11. In the financial system, it is essential to vigorously promote Chinese excellent traditional culture. The most important discussion, as we just touched on, however, is how the party plans to prevent and resolve risks from local government debt. The readout calls for a long-term mechanism to do this and vows to optimize the debt structure of central and local governments. In a note on this point, Goldman Sachs economists expressed today, quote, "This phrase suggests the central government may take up more funding responsibilities and leverage up further, while local governments deleverage and de-risk by resolving implicit debt problems." End quote. That is, taking debt from the local government level where it is highly over-leveraged to the central government where there is some fiscal room. However, some wonder whether the readout suggests there is enough political will to force through the much more needed structural reforms to prevent the debt problem continuing into the future. Duncan Wrigley, for example, chief China economist at Pantheon Macroeconomics, expressed yesterday, quote, "The text doesn't provide an obvious signal that policymakers are about to shift their fundamental approach, such as by taking a more forceful stance to resolve developer debt issues." End quote. US-based Bloomberg summed up the meeting in a few lines. Quote, "China said it would set up a system to resolve debt risks of its local governments as state lenders and top bankers wrapped up a 2-day closed-door meeting to set the priorities for the $61 trillion financial sector." End quote. This all, of course, is no surprise to many like us who have been following this space closely for months now. Quote, "This was fully expected. China has no choice but to resolve local government debt. The problem is that resolving bad debt is just a euphemism for allocating the losses to some sector or other. And for now, it is not clear at all who is going to absorb the losses. I think the main debate among policy-making groups is whether local government debt will be resolved by effectively transferring it into Beijing's books, as many local governments want, or by forcing local governments themselves to absorb the costs, as Beijing wants. The former won't resolve anything. It will simply transfer the locus of a growing debt problem to the last clean balance sheet in China. But to the extent that Beijing thinks local governments can successfully service the debt by cutting back on waste and fraud, they confuse the source and underestimate the extent of the problem. As I see it, the best way, albeit politically very difficult, requires that local governments liquidate and transfer assets they own. But, as of yet, we are only at the very beginning of this discussion." End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Wednesday, and I will see you all tomorrow.